Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 140th VideoCast, 130th podcast for the week ending June 23rd, 2022. Welcome, everyone. We've got a ton of great information to cover today. First off, quick on the media, I would like to thank Finley Walker and Liz Clayman for having me on the Clayman Countdown on Monday of this week. We'll get into this later as we go to the article of the week. Then I'd like to thank Kristen Scholler, Ali Thompson, Talia Torella for having me on Cheddar on Tuesday. And then I'd like to thank Phil Yin and Zaina Al-Shaid for having me on CGTN America also on Tuesday. Moving on to the articles, as always, love to thank Ellen Chang for including me in her article on thestreet.com. This was about where to look in tech for this year, and I talked about Alibaba, so you can read that on the website. Then I want to thank Zoltan Saranyi and Phil Hall for including me in their article on Benzinga regarding Kellogg, the three-way split, which was basically the sum of the parts is greater than the whole. Fast-growing snacks business will get a higher multiple than the cereal business. This is a key value unlock that was not available when snacks were lumped in with cereal. I expect to see more companies to follow suit in coming months. Want to thank Anisha Sirkar and Devik Jain for including me in their Reuters article. And this was an interesting article, got some pushback, but what I said in this quote was that the market, in a sense, may have already priced in a shallow recession with the S&P down over 20%, the NASDAQ down over 30%. You had negative GDP in Q1, so it's possible the second quarter is negative, in which case the recession could potentially be in the rearview mirror. I think the better way to phrase that is more that the impact of the recession on the stock market could be in the rearview mirror, because by the time they announce recession, the market has already bottomed. The market is a discounting mechanism, so the market may have already discounted a shallow recession. I think that's all we're going to get. And if you look at Atlanta GDP now, it's at 0. We're going to get a new print on the 27th. I think that's Monday. And if that comes in negative, although the Atlanta GDP is usually more pessimistic than the actual numbers, in which case more likely we have the shallow recession sometimes next year, but it would be nice to get it over with if we got this quarter of negative GDP, and then you see inflation start to peak, which we saw with the PPI, etc. The worst may be behind us from a stock market standpoint. From employment, unemployment will tick up a bit, probably 1% or 2%. Maybe more, depending how aggressive they get with hiking and how much they understand the lagged effect of policy, and they've got to do something and then wait, do something and then wait. I know there's a whole contingent that want to see them go up to 8% overnight and crash the whole world, but that's probably not the prudent way to think about it. I went through 1,200 different indicators. Yeah, that's right, 1,200 this weekend. And I pulled a bunch. Some of them will be duplicates. I just can't sort through. Out of 1,200, I've got, 100 here. Just wanted to show you guys. I want to impress where we are in terms of an historic level of extreme and how that relates to other bottoms. And, this is consumer discretionary, new highs and new lows. They all have the S&P in the background. In a perfect world, this would have XLY in the background, but they overlap and they basically sync. And you can see these extreme bottoms in the pandemic, and then in 2018 when the Fed messed up in December, and then 2015 and 2016, and 2011 European debt crisis. We're dramatically more oversold than every single one of those instances, with the exception of the pandemic lows. So that puts it in context. Same thing here, new highs minus new lows on real estate. Got this low in 2018, in 2020. I'm going to actually start to click some of these off so we can create some bandwidth here because we've got hundreds of tabs open. Technology, highs minus lows. This is the lowest ever in more than a decade. Lowest ever since they have the data. Much worse than the pandemic lows. So these are times, look, if you're not a buyer when things get this extreme and there gets this much fear, then you're in the wrong business. I'm not saying it's going to be the perfect low, but I'm going to actually cover how you can make a lot of money in your lifetime messing up and not buying the perfect low. As a matter of fact, buying way too early and having it go another 40% against you and still making huge above average money over time, which we covered in the Cheddar interview and we're going to go into in the article of the week. This is NASDAQ, percent of stocks above the 200-day moving average. Again, debt crisis lows, 2016 crash lows, Fed crash lows in 2018, pandemic crash lows, right at this level of 11.63. These are levels where you've been paid massive amounts of money to be a buyer versus a seller. Could it go lower? You bet. But again, amateurs talk in absolutes, professionals talk in probabilities, and that's what we've just tried to hammer home over the weeks and months as we've gone through these different lessons, and it played out in the pandemic, and it's going to play out here again. So NASDAQ above 150-day moving average, so just a different look. NASDAQ above 200-day moving average. New York Stock Exchange, NYSE stocks above the 200-day. Again, you get paid to buy at these levels. Above NYSE above 200-day. You're getting the theme here, guys. I mean, at these extreme levels, you got paid huge money to step in when everyone else was negative and calling for the end of the world. S&P 100, same story. Record high index for the NASDAQ. The only time it looked this terrible was 2015, 2016. You got a monster rally for the next 2 years. By the way, this was in anticipation of the tightening cycle, which went from 2016 to 2018, and the NASDAQ ripped off that pessimism when, after they did the first hike, things started to move up. And I think we're going to see similar story. Same thing, S&P stocks above 200-day moving average, above 50-day moving average. Here's the new highs minus new lows percent on the S&P. Only time it was this low was the pandemic. S&P 1500, which is includes the mid caps. New highs minus new lows. You're getting the pattern here. This is the Toronto Stock Exchange. Same story. Same story. Same story. Same story. Energy sector. New highs minus new lows. The only time it's been this elevated was in 2014, and that was the end of that bull market for energy. And from 15 to 16, I don't think this is going to be the end of the bull market in energy, but I do think the trapdoor is open. As a matter of fact, we're going to look at a chart in a minute that shows the exploration and production stocks down 28% in the last 3 weeks. So the trapdoor is opening. We've been talking about it, and here it is. So financial sector. Spider, new highs minus new lows. I think some of these banks are getting cheap. There's an article we'll cover about Citi. I think Wells Fargo is now cheap at these levels at $37. So we were buyers at 25. We were sellers at 58. Would we be buyers again at 37? I think so. Are we buyers? No, because we got our top 3 positions. We're fully invested. But Wells will be a double from here. All of our top positions are going to be more than that, and that's why we don't have more money going to Wells Fargo. It's as simple as that. But maybe we'll free up some cash to put in Wells Fargo. I'll see. But it's not going to be from our top 3 positions, that's for sure. Same thing, technology, new highs minus new lows. Okay, Dow Jones Industrial, percent of stocks above the 150. Similar story all around, whether it's the Dow, the NYSE, the NASDAQ. This is the mid cap. This is the NASDAQ, etc. 52-week highs minus Dow Jones. Here is NASDAQ high-low index. Here is more NASDAQ, more Dow. Here is Amex. Healthcare, bullish percent, got down really low to 7. That was a buying opportunity, and we're starting to see some bids. I think Cigna got upgraded again today. Technology sector, bullish percent. This is just the number of stocks on a point and figure buy signal. We don't use point and figure charting, but we do like this indicator as the percent that are on buy signals, because when it gets down to this level, you got paid to be a buyer. Again, professionals think in probabilities, amateurs think in absolutes. Consumer staples even got smashed in this environment. There's some things to do there. Transports smashed. some things to do there. Think airlines, shippers like FedEx, etc. Here's utilities even got smacked. So they've taken everything out to the woodshed, even the defensive stocks, even the energy stocks, which was the leader, just to truly upset everyone and put them out of the market, put them in cash, have everyone buying insurance after the house is burned down so they can then rip it higher. And I think that's probably what we're going to see. PPI is a leading indicator that has unequivocally peaked in April. CPI is a lagging indicator that will follow. And we're going to look at commodities. That's why I'm on this computer this week instead of the other computer, because it has much more bandwidth. And we're going to take a look at all the commodities, and you're going to see what I see and say, oh, wow, that's interesting. Because every time I turn on the TV, all I hear is inflation 60 times from Democrats and 600 times from Republicans trying to get elected in November. So you're going to be hearing a lot of that, even as it dies down. Oil could have, and Republicans are going to be singing the inflation song into the election in November. That I can guarantee you without equivocation. NASDAQ, McClellan Summation Index, and by the way, you would too if you were in their position going into an election and that's what you did for a living. So remember, a politician's number one job is to get reelected. And that will never change, and that transcends borders, it transcends generations, and that's just the way it works. McClellan Summation Index, okay, down at these levels, again, professionals think in probabilities, amateurs think in absolutes. You get paid to buy it down at these levels over time, so unequivocally. Here's the 10-year yield rolling over. It peaked at 348, higher than we expected it would. It's now rolled back over to 304. That's a good thing. Here's the trapdoor opening on the E&P names, which we warned about. It's gone from 169 down to 120 in like a half a month, so 29% drop in about 2.5 weeks. There's your trapdoor as everyone was chasing and saying buy the dip. All the people that hated energy in 2020 and were just jumping up and down on TV saying don't buy, don't buy, don't buy in 2020, in the last month is saying buy any weakness. Well, now they're getting their faces ripped off. So here's the dollar. Again, commercials continue to be short. That doesn't mean it drops right away, but it does mean inevitably it's going to drop because that's the smart money. And when that happens, the back half could get an earnings tailwind. This may prove to be an earnings headwind, though, for Q2, which is maybe where we get the that second quarter of GDP for the recession, which would be good to get it kind of largely in the rearview mirror as it relates to the stock market. Lag basis for the real economy. Stock market's a discounting mechanism. Look at the euro. Commercials were buyers here. You eventually get a rally. Buyers, again, not overnight, but eventually you get that rally. They're big buyers here. I think the euro is going to be a buy here, and it's just a matter of months as the dollar weakens. You see all these instances where the commercials were aggressive buyers ahead of time. You get these massive rallies in the euro. No one's looking for a euro rally here under any circumstance. Or a weakness in the dollar, and that's usually exactly when you get it. Do I know exactly why? No. But I know about smart money positioning, and I know how it's worked historically. Professionals deal in percentages and probabilities. Amateurs deal in absolutes. Nothing's a guarantee. We play the probabilities. Same with the pound. No one wants to touch it with a 10-foot pole. That's probably due for a bounce as well. Moving along, Canadian dollar, as we always like to say, doesn't really matter in the scheme of the global economy. But for the Canadian viewers, we love you very much and appreciate you, and are grateful for all the incredible hockey players and actors that you've sent to America. So there. And we wish you could be sending that beautiful tar sands oil to our country. If we had an administration that had approved the Keystone Pipeline, we wouldn't even be talking about this. But we are where we are, and hopefully we'll get to benefit from your great and ample and fruitful country full of beautiful natural resources that can fuel the world. But for now, we've shut the border, and we're not accepting the incredible assets that you have to offer, which is beyond me why we would ever consider doing that. But it is what it is. That's what was voted for in the last election. That's what we got. No surprises, and so now we have to bear the consequences and hopefully find a solution in a scramble to move it in a different direction. New Zealand dollar, nothing clear stands out there. Brazilian real, I mean, you got massive selling. I don't know. How low can this thing go, though? I mean, that thing has been, so no view on that. South African Rand, same thing. This unabating weakness for many, many years. Russian ruble actually is the strongest it's been since the war. It's stronger than it was in the pandemic, which no one was expecting. But China and India are taking the amazing opportunity that the rest of the world has afforded them to buy unlimited quantities of Russian gas and oil at a tremendous discount to the market, and they're loading their stockpiles at clearance sale prices. So Russia's probably making more money than they would have without the sanctions, because these two countries that are resource poor are stocking up at huge discounts. Russia's hands are tied behind their back because they have no other customers, so they have to charge a huge discount. So while we pay $110 a barrel, China and India are paying fractions of that, loading up their strategic petroleum reserves while we're choking at the pump. Talk about clever policy, and way to go, guys and gals. So, okay, so energy and let me see here. We got clicked out of that. Let's just get it back real quick. Where were we? Ethanol. Yeah, ruble. Okay. I just want to go through all these. I want to especially get to the softs. You know, that high in energy is still held, that spike high. So let's see. That's gasoline, natural gas. Commercials are starting to sell. That could take some time. You could get another spike high. It's possible. Crude, this is Brent crude. That spike high from March is still held. Let's see, ethanol. Bonds. Let's look at the 10-year versus the 30-year. Okay, so the 10-year, I love this chart because look what the commercials. There've only been basically a couple times in recent history where commercials have been buying this aggressively. Sure, it kept going down and then it bottomed, and you got one of the biggest rip your face off rallies in 2019. You're seeing massive commercial buying into this weakness, and it looks like this week bonds started to rally a little bit. We'll see if we get any follow through. They're up today. The 10-year yield, as you saw, has collapsed from 348 down to 304. So this is pointing in the right direction. But look, when you see buyers, eventually you get a rally. Buyers rally. Buyers rally. Buyers a little rally. Buyers a big rally. Buyers, we're going to find out. But that could change the game in terms of the stock market, in terms of what let us down, tech, etc., leading us up. All right, come on, let's get to the shorts here. The softs, rather. Okay, euro dollar, that's another rate play. So for corn. Okay, corn, look at the amount of selling these commercials did. This looks exactly like 2011 to 2013. You had big selling, then they bought in a little bit because they were early, then they started selling again down here. I think corn's going to collapse over the next 2 years. That's really what I'm seeing. And there's a leading indicator with fertilizer prices. This is kind of that second blow off in here. This is like record selling. Same thing. They were selling here. They were too early. They bought, they sold, and then collapse. So corn is probably an interesting short if you have a 12 to 24 month horizon. Same with soybeans. Look at this record selling. They were selling. They were early. It came in a little bit. Then they sold again, and you got the final collapse. Same here, and final collapse. Same here. So corn, soybeans, all these staples look like they're about to collapse. I don't know what the catalyst is going to be. I don't say that with a surety. I say it with probability. That's why I show you all the historical instances. Go to hedgefundtips.com, click on terms. This is opinion, not advice, etc., etc. Soybean oil, same thing. It looks like that second top is in, and it's starting to roll over and crack already. What do we have here? Wheat is already cracked. That's good to see. Which you'd never know if you by watching conventional news media, because everyone's talking about how it's the end of the world. Look, it hasn't been fun, that's for sure. Oats are starting to roll over. Rough rice, no one really cares about. Canola, wow, canola has really come in. S&P, what do you have? Just the opposite. While they were selling before this rollover, they're now buying. Selling before this rollover, then they started buying, and you got the rally, etc., etc. Selling here before the rollover. So it's not perfect every time. Particularly, don't use the E-minis. A lot of people point to the E-minis and they get faked out. Commercials, large traders don't use the minis. Here, the Dow, they're buying. Same thing here at the pandemic lows. They're buying. Then you got the rally. Russell, massive buying. And by the way, interesting thing about the Russell, small caps have done nothing now for 4 years. We'll look at another chart that shows that. But just look at this level of commercials buying. The valuations are at historic lows. That's something worth looking at. The VIX does this very often. So you had the big crash in 08, then it comes down, and then you get this after tremor. Same thing, we had the big crash during the pandemic, then you get this after tremor, and everyone looks with recency bias. Well, when it goes back up over 80, that'll be capitulation, and it never does. You don't get, probabilistically, you don't get 2 heart attacks in the same couple of years. You get a heart attack every 10 years, give or take. Here is the, let's see, what else do we have here? Live cattle. It came in a little bit, but it's still elevated. That works on a lagged 6 to 9 month basis. Let's look at lean hogs. Not yet ready to crack. Let's look here. Pork cutout. That must be a new contract. Milk. That's thinly traded. Non-fat milk. They really trade non-fat milk futures, butter futures, cheese futures. Man, they got a lot of free time on their hands in the Midwest where they trade these contracts. All right, gold. Commercials have been aggressive sellers through this whole strength. Now, it doesn't mean that can't keep peaking up, but last time we saw this type of rally and double top like this with commercials as net sellers, you had from 2013 to 2007, just a constant downtrend. But all the gold bugs will tell you, well, inflation is unsustainable now. This is going to go to 8,000, and they may be right. But the smart money is telling me a completely different story, that 2 years out, gold is lower, not higher. Non-consensus, but, just go with probabilities, not absolutes. High-grade copper cracking, rolling over. That's good news. They were selling this strength. You had this top build just like you had in 2011, selling the strength, top build, and then boom, and then a multi-year downtrend. Moving right along, platinum has been weak, no view there. Palladium had that final spike peak in March. It's been rolling over since. That's good to see. Cotton. Cotton is just starting to roll over. See, they've been sellers into all this strength. Now they're buyers, and that's when it starts to roll over. Same thing here in 2011. As they start to be buyers, boom, you get the crack, and then you get a collapse that goes into all the clothes that you wear. Coffee, same thing. They've been huge sellers into this strength, and then boom, you get the topping, crack, and roll over. I'd be short coffee on a 12 to 24 month view. Sugar, same story. All the things that people think are going to go up forever, the smart money is showing you is not. Cocoa's already coming in. Lumber completely collapsed, down from 1,700 down to now 590. So that's that. Moving along, orange juice. That's idiosyncratic, but they are sellers. I'd be short. Gun to my head, short or long. I'd be short. Sugar, yeah, definitely short this season. Yeah, I towards the end of fall, I don't want to be short going into February. You get a freeze in Florida, you're toast. And that's it for commodities. So I'm glad we got through those. Some articles of the week. Wall Street's classic strategy set for worse quarter than 2008. Basically, what they're showing here is that the 60-40 bonds, nothing's worked this year. You couldn't hide in bonds. It's worse. You've had the worst quarter. It was worse than the great financial crisis, because during the great financial crisis, when stocks were collapsing, bonds were going up. This quarter, everything was going down. Worst quarter in history. Everyone says, wow, that's terrible. I say, wow, that has created like unprecedented opportunity that we've not seen in history. But that's just me. I look for the opportunity and the difficulty. Most people look for the difficulty and the opportunity. Lagarde restates ECB hiking plan as crisis tool takes shape. Basically, you want the summary of this article. Italian yield spiked to 4% last week. They held an emergency meeting, and they decided that they're going to do QE again, even though they're pretending that they're tightening on the rates, which they're going to continue to do, maybe one or two more hikes. But they're back in the market buying the periphery PIGS bonds, which is quantitative easing. They can call it whatever they want, but that's what they're doing. They're buying bonds. So now you not only have Japan in the market buying unlimited bonds, trying to get an export advantage over China by debasing their currency, but you also have Europe back in the market buying bonds. Biden says he and China's Xi, to talk soon, weighing tariffs. He's going to remove tariffs likely on $300 billion of goods. That'll help our China stocks. Don't know if it'll do much by way of inflation in the U.S. It might have a modest impact. It can hurt from a price standpoint, from a political and strategic standpoint. That's a different story. But we're not in the business to have ideologies. We're in the business to make money. China stocks will go up. New Oriental shares soar on new live stream success. This is an amazing story. As a matter of fact, I post some of my article of the weeks on Seeking Alpha, and they invited me to their office on Vanderbilt in the city last week, and I met this guy, and he was Chinese guy, Chinese national, and he was telling me about the CEO of this company, EDU, is the ticker, and how basically he's burned the bridges. You know, the government shut down the education business. He sold off all the buildings. He's told the activist shareholders, I'm not liquidating the company. I built this once, I'm going to build something again. And he's pivoted to this live stream business. He even did a live stream himself. They're cooking in that business, and the stock is up. So all these companies, you know, Didi, the same thing. They're getting back on the app. They're the Uber and Lyft of China. The company was delisted. It trades on the pink sheets just fine. So everyone afraid of delisting. Even if you didn't switch to Hong Kong stocks, it'll be a pink sheet stock, and it'll trade just fine, just like Tencent. And now these stocks are starting to go up materially. Some of them have doubled in the last few weeks. So the ones that left for dead, if you're patient, you get rewarded. China stocks are bucking global market volatility. Tech is leading the way, so opinion follows the trend. You're seeing more and more positive articles about Chinese stocks. Citigroup is the cheapest stock of the big banks. This is from Carlton English. She's a great bank reporter over at Barron. She was very helpful during the pandemic, when she was one of the few people writing about bringing those reserves back onto the balance sheet. I know she reads this note each week and VideoCast, and she's just done an incredible job in that sector. Mario Biopharm and Theseus Pharmaceuticals see activists from activist investors. The game is on in biotech. We're going to talk more about that. China studying, this is a few days ago now, they're doing, but before they were studying extraordinary support for manufacturers, and this is to promote consumption. If you read the entire article, China imports Russian crude oil hit record high. They are loading the boat. They are buying like they did in 2016 when U.S. was puking and choking on oil. They were loading their strategic petroleum reserve. They did the same thing in 2009 when everyone else was puking. China was buying, just like Trump was buying in the pandemic. While all the commentators are on TV were saying to sell, Trump loaded our SPR, which gave Biden the latitude to put out 1 million barrels a day. Russia and China are following suit and getting a huge bargain from Russia. China and India are following suit and getting a huge bargain from Russia. China's stock rally is becoming a lifeline for Asian portfolios. China is outperforming everything in the last 3 months since they bottomed in March, in our view. China IPO fundraising doubles U.S. total to top global ranks. So we put sanctions on them to not do raises, so they just did it on their own, and now they've left us in the dust. So unintended consequence of not well thought out policy decisions. Macau gaming overhaul law approved, casino licensing to restart. That'll be good for the Winds and the Las Vegas Sands, which we like, and the Melco Crowns. They've been in the gutter because, on and off again, COVID, border restrictions, et cetera, et cetera. Now the licensing is done. That's the most important thing. COVID is fleeting, but the licenses will be permanent now that they're approved, and these things will rip higher, and no one will be paying attention. Once they're up double, people start paying attention to them as well. DD apps ousted from China app stores for privacy reasons near their return after ride-hailing firms NYSE delisting. If you remember, they listed without the blessing of the CCP. The CCP shut down their app, put them in the penalty box. Everyone got scared. It was part of the reason for the collapse in tech stocks. Now they are trading on the pink sheets just fine. They're starting to get a bid. They're getting back on the app store, et cetera, which is why every time you see a story about the Ant Financial IPO coming about, some as quickly as next month, probably be delayed now that it got so much media coverage. The pulling of the Ant Financial IPO is what started the China tech depression, and I say depression, the K-Web was down 80%. There's only been a few times in history you could buy a whole group down 80%. One was the Great Depression if you bought the Dow Jones. The second was the tech wreck if you bought the NASDAQ in 2002. If you bought during those times, you made generational wealth. And the third one that I've seen is China Tech, which ended in March. And, the bellwethers like BABA are now up 45 some odd % off the lows and dramatically below their intrinsic value. We believe trading around a third of their intrinsic value at present, and that'll take a few years to play out. Apple's iPhone output said to have soared in China. That's some good news amid the tech sell-off. China vows more pro-growth policies as banks urge to step up. Banks are called to increase funding for infrastructure. Macro policies. There are a few of these articles that were just about pushing consumption. It's all interrelated. If the economy does well, consumption goes up. So they're pushing banks there. Jack Ma's Ant to apply for key license as soon as this month. This is from yesterday. And central bank plans to accept Ant's application and begin the review. Ant said it has no timetable for submitting application. They have to deny until the CCP gives them the blessing. But, all these leaked articles from sources are saying it's moving forward, plus that lady going on the board that runs the Hong Kong exchanges. Why would they put her on if they weren't going public? Wall Street faces billion-dollar losses on sinking buyout debt. This is very important. So credit markets are closed. The 10-year yield has gone from 132 to 340, and now it's round tripping back to 304. As that starts to go down further, and we see that earnings are modestly better than expected in the next few weeks, and we get a summer rally as our expectation, then we'll see these credit markets unplug. Why does this matter? So basically, they financed a lot of LBO debt, and they guarantee the pricing at issuance. So the banks are choking on this debt that they can't sell now that rates have shot up so much. The bonds have fallen, and they've got $80 billion worth of commitments backing this type of debt. So the high yield market is temporarily impaired. That's why you have companies like Cooper Standard trading at such a huge discount for fear that they won't be able to go into the market. That's the bad news. The good news is, we've got a year and a half in terms of Cooper Standard, and my sense is they're going to generate enough EBITDA and generate enough cash that they don't even need to refinance if they don't want to. They'll be able to just pay it off from cash if need be. But as is always the case, and I've shared this story before from my favorite movie of all time, Swingers, with Vince Vaughn and Jon Favreau when they're driving from LA, they're aspiring actors, they're driving from LA to Las Vegas, and Mikey, which is played by Jon Favreau, Trent, played by Vince Vaughn, is sitting in the passenger seat of their, I think it was like a Ford Fairlane convertible, driving that long trek from LA to Vegas. I've done that one time myself, by the way. And Trent starts putting on the suit. Mikey goes, "What are you putting on a suit for? We're going to a casino." And Vince Vaughn turns to Jon Favreau and says, because when you don't need the S, they give you the S in terms of comps. And that's exactly the case with Cooper Standard. They'll bang out a quarter with 30-40 million of EBITDA like they did right after the pandemic before the chip shortage. And then all the banks will be begging for their business, and they'll not only refi the term loan, they'll probably do the senior secured in one full fell swoop. If the terms are attractive, if they're not, they'll just do the term loan and then do the senior secured the following year, or just do it from cash. But either way, that's what's created the opportunity in the equity, and this has been basically, explicitly frozen in the last month, which now it should start to be thawing as yields come out, but everything works on a lag basis. But that's what's created the opportunity in the equity. So when people say, well, how are they going to refinance? Well, that's why you've got the opportunity to buy what was a $3 billion company on normalized EBITDA, now trading at $70 million. It's certainly high risk, high reward. But if you look through, your bet is one of two things happens. One, the credit markets reopen in a year and a half, or two, the chips come in. And what we've seen from the notes we've looked at and the people that we've talked to, I know a number of dealers. Two things. One, they're picking up one of my cars to do normal service on Monday. I asked them if they're getting cars in. They said they had such a dry spell for the first part of the year, and in the last 2 months they're getting tons of deliveries. Now that's kind of a niche auto manufacturer, Italian. I'll just leave it like that. But I do know, I play golf with BMW dealers and guys that own BMW dealerships and Ford dealerships, and it's getting better across the board, which tells me that my thesis that the chips have started to come in is playing out. And I think we're going to see that accelerate. Yesterday's shortage will be tomorrow's glut. High prices cure high prices. So, okay. Emerging markets valuations have never been better. So what are they talking about here? The valuation gap between U.S. tech and Chinese tech has widened considerably, with bellwether Chinese stocks such as Alibaba and Tencent trading at multi-decade lows. All right, we've beat this dead horse over and over. Alibaba's the cheapest it's ever been on a PE basis, no kidding. While Tencent hasn't been this cheap on a P price to book basis in 20 years, etc., etc., etc. So you can read that on your time. Dallas Cowboys owner Jerry Jones scores $1 billion natural gas gambit. Football team owner bought control of Comstock Resources at the depths of the gas bust, and now his stake is worth more than twice what he paid. So is ours, by the way. We've talked about that in our podcast. We still own a good slug of Comstock, and we will buy it we will own it even as the trapdoor opens for the general energy sector. This is a 3 to 5 year play in the natural gas. And if we have capital free, we'll probably buy more if it gets hammered in coming weeks or months. But that's a secular play, the natural gas plays. And we've talked about Range Resources over and over. Big options bet is positioning for more gains in Chinese stocks. So there's more than 200,000 contracts change hands in the trade that had two legs and involved the buying and selling of contracts with different strikes. This regards A shares, ASHR. That pushed the daily options volume 523,000, 8.5 times the average turnover in the past 20 days. So opinion follows trend with these stocks up 40 and 50%. Now everyone's chasing and buying the options, which is great because then the dealers have to buy the stock, which pushes the stock higher, and the game is on. China's payments, fintechs sectors to play bigger role in boosting the economy, President Xi says, is a positive signal for big tech. Fintech sectors to play bigger role in boosting the economy. What is the number one fintech play in China or the world, by the way? They do 25 times the amount of turnover volume that PayPal does, Ant Financial, and that excludes its asset management business, et cetera, et cetera. It's kind of like merging Visa and BlackRock in one business. It's unbelievable. But now Xi is giving the CCP blessing, and if that's a smart move, because then it'll go public, it'll be able to raise capital, expand, and Baba shareholders own a third of that business, which is now valued at $188 billion, which will be valued at $1 trillion. It's just a matter of time. And that's $333 billion to Baba owners, which is more than the entire market cap of the Baba business. Oh, and by the way, you get Amazon Web Services and Amazon of China for free. How's that for a deal? I mean, this is just exciting. So nonetheless, China's Xi vows more forceful tools to achieve this year's economic targets. He realizes there's something called a calendar, and he's got the China National Congress in November. We'll step up macroeconomic policy adjustment and adopt more forceful measures to deliver the economic and social development goals for the whole year and minimize the impact of COVID-19, which is basically saying we're not going back to COVID-0 if we can help it. We got to hit 5.5% GDP. There are a lot of people in those 100 families that control the country that are not happy with me. My power is not unlimited despite the media narrative, and I better get my S together before November and juice this economy, and that's exactly what he's going to do. And he will do whatever it takes. And then as our inflation's rolling over, theirs will be going through the roof next year, but it is what it is. The stock market has fallen, but earnings expectations haven't. Why is that a problem? So this is an article about everyone. Consensus is now we're going into a recession. Earnings are going to drop 20%, and then you put a multiple on it, and the S&P is going down to 3,000. It's possible. It's not probable. And I'm going to show you a chart. What everyone's forgetting here is earnings are in nominal terms. They are not in real terms. So everyone's wages have gone up. Prices have gone up. By the way, earnings have gone up. So even if earnings have only gone up, if real earnings have gone up, de minimis, but prices have gone up 8%, you're still going to see 6 to 8% top line growth, 6 to 8% bottom line growth in nominal terms, even if the real growth is not that good because we've had this level of inflation. So you'd really have to drop on a nominal basis, like 20, on a real basis, you'd have to drop materially to see these kind of things that they're looking at. And the problem is 90% of these analysts that are writing these reports have never seen inflation, so they don't understand properly the difference between nominal and real as it relates to top line and bottom line, and that's why we'll see some drops. We'll probably see a 5% drop, and then people will panic and say 25% is coming. The market's not low enough, and maybe they'll be right. But I would reserve judgment. When the facts change, you can change your mind. Right now, earnings are going up every single week. And they're going up for a reason. It's not like, let's make the worst call we can make so we have career risk. It's like they're seeing in their channel checks and talking with management that on a nominal basis that things are going up. So even if real growth dropped 4% and nominal growth and inflation is +8, you get a +4. This is not, my fifth grader could do this with her eyes closed with variables in the equation, and it would be a slam dunk. So you have to keep an open mind on that. A shocking number of stocks are in the red. Here's why that's a bullish sign. This is a note from, I don't know why this keeps logging out. Could someone just make a thing that never logs anyone out of anything? So this was a note from Bespoke, and it basically said, so many stocks ailing. Okay, with so many stocks, all right, there's a laundry list of problems, and it means that almost no stock is immune from declines. In fact, the S&P's cumulative advanced decline for the 10 days leading into Tuesday revealed an especially low number of stocks rising. That number subtracts daily declining stocks from daily advancing ones and adds up to each day's tally for a 10-day period. If the number is net negative, it means there are more stocks falling than rising on a daily basis. You saw the visual of this basically in the 100 charts I showed you at the beginning of this call. Coming into Tuesday, the number was negative 1907. That's worse than the majority of 10-day stretches during the past 20 for stock market corrections dating back to 1990, according to Bespoke Investment Group. When so many stocks are ailing, the market tends to perform handsomely from that point forward. In the 6 months following the advanced decline readings that Bespoke deems extremely negative, the S&P averages plus 13% gain. Looking 1 year out, the indices see a 22% rise. So, again, professionals deal in percentages and probabilities, amateurs deal in absolutes, but for my money, a 20% rise, everyone's looking to sell. As a matter of fact, if you listen to the Cheddar interview I did this week, you can see the tone of the questions, and if you look at the banners that they put under when I was talking, the banners did not correlate with what was coming out of my mouth. But it's this overriding negative sentiment that everyone is feeling because people are feeling it in their pocketbooks every day in food and gas in the short term because everything's on a lag basis. You're going to see the embodiment of that and how everyone's selling. And what I told Kristen was, she said, so should investors be selling here? I said, look, I've said this before, the time to buy insurance is before your house is on fire. Right now, the house is already burned down. You've got to, this is the time to be looking at opportunities and moving in on a selective basis. You've got companies like Disney down 55%. Just, hold your breath and think 3 years from now, are more people going to go to the parks or less? Is Disney Plus going to be in more international countries and with more children watching their family programming on the streaming or less? Are they going to put out more good movies or less? And the answer to your question is unequivocally more. And it's trading at 50% off, but no one's interested. So to get back to its highs, whether it takes 3 years or 5 years, it's got to go up 100 plus, 120%, 115%. Just to get back to its old highs, and Disney will invariably make new highs, and that's over 3 years, 5 years. There's money to be made. If it drops another 20% from here, does that mean it's not going to highs? No, eventually it'll work up to new highs. So buy a third if it goes up, buy a third if it collapses, and eventually you'll get a decent price. But you got to take advantage probabilistically when the market serves this stuff up. Starbucks down 42% on China overhang. You heard the man. He's going to do unreasonable, forceful stimulus. Forceful stimulus! What else do you want, guys? Chair Powell's on the Hill for 2 days talking about, fumbling his thumbs. Well, we might get a recession. And Xi is over there saying, I'm going to be so damn forceful, I'm going to force this economy to grow at 5.5% if it kills me. And everyone's saying Chinese stocks are uninvestable. Wake up! You've got one half of the world that's tightening to destroy consumption, and one half of the world that's easing to drive consumption and trying to do it as fast as possible, preferably before November, the China National Congress election. So wake up is what I have to suggest. Sorry to get so excited about that. That's, by the way, coffee free. That's just natural excitement, I got to tell you. Okay, Powell is focused on curbing inflation, even at the risk of provoking a recession. We covered that. Xi reaffirms growth target that analysts say is out of reach. President says China will strengthen policies to meet goals, while economists have cut their forecast to 4.1% from 5.5%. Yeah, they're going to get this done by hook or by crook. I mean, barring some ridiculous wave of COVID and they do some stupid COVID zero, which is highly possible. I don't know that it's probable at this event, at this juncture, but it's possible. And then coupled with that, let's see, where's the other guy? I don't know. His number 2 guy came out and basically said, we're going to drive consumption like it's going out of style. We're going to do everything to push consumption because that drives the economy. I tweeted it out so you can check. Oh, here we go. Premier Li Keqiang urged authorities to roll out as many policies as possible to boost consumption, saying it's an important driving force to get the economy back on track. Who benefits from consumption? Number 1, Alibaba. So there you go. Some tweets. Benjamin Graham, operations for profit should be based on not on optimism, but on our arithmetic. And we've gone over all the valuations for biotech, for BABA, for Cooper Standard, etc. Buffett, just to reemphasize, great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. This is textbook. This is over the weekend we got a new dog. We got another dog which we named Pepper. This little one here. This is a Maltipoo to keep our existing dog Lucky, a Shih Poo, company. Now, we weren't giving Lucky enough attention. I mean, when I'm not working, when the girls are not doing their schoolwork or swimming or whatever, we give her attention. But we're not like sit on the couch kind of people where the dog sits on our lap and we watch TV all day. So, I was like, what are we going to do here? We're never here, and I'm playing more golf when the markets are not open. So my mom came up with this idea. She was like, because I kind of was, gently talking to my mom about laying off the dog on my mom. And she's like, listen, you could get another dog. And I said, that's absolutely brilliant. So we did that, and it happened to coincide with the girls' birthdays, which were the 17th and 18th. Now, I voted to name, because you're stuck, lovable dog, but it just wasn't working great. So I voted to call this new dog Double Down. That was going to be the name of the dog. And if you watch the movie Swingers from 1995 with Vince Vaughn and Jon Favreau, which is the only movie I've ever watched more than once, there's a scene where he goes double down. I thought this would be the perfect name for this dog. We were stuck, and then we doubled down. And by the way, it's worked incredibly well. So long story short, I lost the vote. The dog's named Pepper. They work great together. They're so happy together, which makes me super happy, makes the girls super happy. Everyone's happy. Great investment right there. Now, here's also what got the market a little bit better this week. Bullard over the weekend, who's been super hawk, all of a sudden comes out and said, we don't have to go as far on quantitative tightening as it might seem, which means he saw what happened to Italian bond yields last week. He saw Lagarde do a backflip emergency panic, which she had to because she had no understanding of where the market was until it happened. And he's like, we cannot afford that with U.S. Treasuries. So let me walk this back. And the market really, really liked that. The thing you need to understand is there's basically there's something called coordinated global monetary policy, which is done at the Bank of International Settlements, where all the central banks kind of coordinate policy. And basically what it seems to me is the quid pro quo is they're going to let Japan devalue their currency into the oblivion to give them an exporting advantage, dramatic exporting advantage, because they have basically no inflation on top of it, while they do quantitative tightening, they meaning the West, US, Europe, etc., and on the assumption that the Bank of Japan will pick up the slack. So we'll let you devalue your currency. We won't fight you on that with currency wars. You'll get an export advantage. They'll give you a competitive advantage over China on the export front. But you need to buy all of our bonds that we're dumping off of our balance sheet, which you can do because money is still free in Japan, and the spread on the carry trade to borrow at negative rates and buy at 10-year at what was 350 is now 3%. It's free money all day long. Same thing with Europe, buying Italian bonds, et cetera, et cetera, et cetera. And it will allow them to inflate away their unsustainable debt to GDP ratio. That's what most of the Western world is trying to do, by the way, is their debt to GDP ratios have become very high along the lines, and in many cases higher than post-World War II. So the way that they did it in the 50s and 60s is they inflated that away with growth and higher than trend inflation. If you remember, there was below trend inflation from 1930 to 1948, and then above trend after, when they had to inflate away all the debt that they raised to finance the war. The same thing is happening. The difference is it was an invisible enemy with COVID, and that's basically what's happening in the West. So part of this is by design, part of it's by accident. The gas prices, they didn't realize the unintended consequences of stupid policies, but nor did anyone really predict the Russian war, which was kind of a curveball. But you deal with it, roll with the punches, and that's that. But this is huge, coming from the most hawkish guy on the Fed, that basically he's saying, we thought we were going to be able to do quantitative tightening. It just ain't in the cards, more or less, is what he's saying. This is very important. Jurien Timmer put this out, which is basically what I've been saying, and he says, the market is nervous about earnings. Maybe inflation is why estimates are holding up so far. Duh! The chart illustrates that nominal earnings growth often holds up well during periods of high inflation. Think 1940s, 1970s. So it's not a given that earnings are about to crater, and this chart shows his case in point, and that's what we think is the case as well. Real earnings growth may be static to declining with a slowing economy, but nominal is doing much better. This chart is very interesting. It shows the S&P 500 making lower lows while biotech is making higher lows and leading out. Same thing with China tech having bottomed in March. Biotech is showing the same tendency. Here's a chart from J Capital. If I were compelled to make the inflation may soon wane start to argument, I can think of worse places to start with these two charts. So he shows crude rolling over from 120 down to 104, and then copper, starting to collapse from 480 to 399. And we've gone through all those commodities earlier in this thing. Seth Golden puts out, when open interest leverage is this low, good things happen. He's showing Dow futures open interest in the last few times. This is just another indicator along with the hundreds that we covered. Here's momentum based. This is a 14-week stochastic. Again, paid you to be a buyer versus a seller. Market's as oversold as it was in the March 2020 lows. How many of you wish you were buyers in the March 2020 lows when I put out that article on March 19th of 2020 that made Market Watch when the Dow was down 33%, and I said that even in the 1918 pandemic, the Dow only dropped 35%. We're net buyers here at these levels. If you could go back in time and buy at those 2020 lows, would you? Well, it's the same setup. Are you going to get the same outcome? There's no guarantee of that. But again, professionals deal in probabilities, amateurs deal in absolutes. You should be, in our view, again, do what you want, click on terms, talk to your financial advisor, etc. But if you're not buying high quality businesses on sale, at least starting to get small pieces of it, then it's not the right business for you. That's the bottom line. I mean, you can't outperform over time if you're not buying when everyone else is puking. That's just the way it works. Buy the index fund and go, find another awesome career. Go into real estate. You can make a fortune. Go into, start a company in tech. Do something fun. Okay, bit difficult to suggest the NASDAQ unwind is analogous to the dot-com bust. This is from Seth Goldman. He took these charts data, I think from where is this from? The Irrelevant Investor or something like that. Anyway, it shows the multiples today in tech relative to the multiples in 2000 at the peak of the tech wreck. And it basically shows on a weighted basis, if you take all the biggest companies and the weights, etc., that the multiples today are somewhere between 47% and 67% lower than they were at the tech wreck peak. So the comparables are non-existent, number one. And number two, these companies are cash machines, growing cash machines. And number three, you had, again, a 10-year at 6.8, not at 3.04. Cost of capital was much different. This is from Sentiment Trader. This, again, we covered this, stocks above the 50-day moving average. If you bought at any one of these points in time, which we are now, on average, 1 year later, you're up 27.65%. So here's Dietrich from LPL Financial, always puts out great stuff. Good news is a year after such events, when you have a 5.8% weekly drop for the second consecutive 5% down 2 weeks in a row, here's what happens. 6 months out, on average, you're up 13%. 12 months out, you're up 28%, which, by the way, is consistent with the last one from Seth. So that's pretty good. My friend Tiho put this out, which is really fascinating. Everyone always puts out these ridiculous arithmetic charts, which is shocking because most of the people putting out the ridiculous charts are CMTs who are supposed to know better that you use logarithmic charts, not arithmetic charts, which look ridiculous. But nonetheless, here's the antithesis of that. Here's an arithmetic chart of the NYSE composite, a broad-based selection of stocks, and it shows that as much as everyone says bubble, 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 we've had 2.1% compound annual growth rate over the last 15 years when you look at a broad basket of 2,000 NYSE's. Is it 2,000 or 1,000? I'm not sure what this ETF specifically measures, but it's at least 1,000 stocks. And it shows this oversold measure, and that's exactly where we are. It looks more like a breakout back test and then a long-term trend, just like you saw in, by the way, 1994, where you had a similar situation, and then you had a 5-year run that compounded at 27% a year. So here's the Russell from the Pratty charts, just showing what we said before. The Russell 2000's done nothing in 4 years. But most of the businesses have grown earnings over that time, which is why the valuations are at historic lows. So you can sell them in the hole, or you can start to nibble on opportunity. This shows what we were talking about before, the worst quarter ever when it comes to a balanced portfolio. Second to 2008, it got down negative 20%. Here we were down, when was this posted? It looks like it was June 21st. So as of 2 days ago, we were down 18% on a 60-40. That's why people are panicking. That's why consumer sentiment is at all-time lows. But should you have been a buyer or a seller here? Well, we're going to find out in the article of the week, because here's from Macro Charts. He always puts out great stuff. Asset manager positioning, all equity futures, a percent open interest, which we looked at in another chart. This is the lowest it's been ever in the data that is available from the CFTC. It got this low during the European debt crisis in 2011. That was a buying opportunity. The 2015-16 crash and the pandemic low, it didn't even get this low, and now. So you could be a seller in the hole, but statistics support you're going to make more money if you look out 2 years being a buyer than being a seller, and it could be a lot more money. So I had fun with the article of the week this week, as you can see. I've been seeing this meme for ages on Twitter with all different things written in these boxes. The article of the week is called Should Have Been Me, Stock Market and Sentiment Results. And so here I put, U.S. asset manager, kind of with his, has been kind of married to Fang all this time. And now he's starting to look at, other people, and that other person is China Tech for sure, and the narrative is changing. So for those of you who've been on Twitter for some time, you're aware this header image meme has been around for a while. We adapted it to embody the dilemma U.S. managers are facing as we enter a world where the West continues to tighten policy to slow consumption, while China and Japan keep the full pedal to the metal, easing monetary and fiscal policy in an effort to dramatically increase consumption. Chinese stocks seem to have bottomed in March as Fang, Facebook, Amazon, Apple, Netflix, Google, and also Microsoft, by the way, have continued to weaken. Alibaba, the China tech bellwether, is up over 45% off of its March lows, I think a little bit more today. Managers are starting to take note. This Miley Cyrus ode to Pete Davidson and his move to Kim Kardashian embodies the shift in attention to new horizons, i.e. China tech, as US and Europe languish for the time being. My favorite saying, opinion follows trend. So you can listen to Miley do this. I couldn't find a better copy. I guess they've taken it off of YouTube, but it's a funny kind of ode and song for sure. Worth a watch. Fox Business on Monday. I joined Liz Clayman on Fox Business, the Clayman Countdown, to discuss opportunities in down market. Thanks to Liz and Finley Walker for having me on the show. So the fear over the weekend was earnings recession, earnings recession, earnings recession. But if you look at the numbers, they keep going up every week. 251.76 estimates for 2023, which means we're now trading at 14.6 times next year's earnings. I think it's probably 14.7 since I did that segment, or 14.75. With rates still relatively low, 1.5 on the Fed funds rate, headed to 225 probably over the summer. and then it may be a pause. This is below the 5-year average of 18.6 times, which includes the last tightening cycle, which went from 2016 to 2018. So dramatic discount. And what I said was this has been more of a multiple recession than an earnings recession so far. And I said the quote, which Liz liked a lot. Those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance. And that is certainly not the case right now. Most commentators are downbeat. And I think the Cheddar interview embodies this. You're going to see such a kind of negative, fearful context, and I'm trying to lay out the case of what the potential upside is. And like there, when there's no like reception for that level of opportunity, you're at or near the bottom, and that's just normal human emotion. And they're right on the floor there, so they're around it all, and that emotion seeps in, which is why Buffett specifically chose to live in Omaha. He didn't want to be around the groupthink on Wall Street, and which is why I spend a lot of my time in Connecticut too. All right, those who invest. Okay, as an investor, widespread fear is your friend because it serves up bargain purchases. Personal fear is your enemy. Now, this is a very important point. So there's so much anxiety about picking the bottom, okay? Now, if you bought the S&P 500 on the day that Lehman Brothers went bankrupt on September 15th, 2008, the S&P closed at 1,192 that day. It was down 26% from its highs. In the short term, you felt a lot more pain because from that September 15th to March 9th, the S&P fell from 1192 to 666. It fell another 44%. So you say, oh my God, what if I buy too early with the S&P down only 23% and we fall another 44%? Well, think about it this way. Since then, even with the recent correction, with the S&P down 20 some odd percent, you would have earned about 14% compound annual growth rate, including dividends, just in an S&P index fund over the long term, which is close to 2 times the normal average. So you'd earn about 14% including dividends versus 8 or 9% long-term average, less than that over the previous 20 years. In other words, you doubled your money every 5.14 years instead of every 9 years, even though you didn't pick the perfect bottom and bought way too early. And that's how you have to think about it when quality businesses are on sale. You're not going to pick the perfect bottom. Who do you think you are that you are going to be the one to pick the last tick? The key is buying when there's blood in the streets, even when some of it's your own. That's how we took our basis down on Alibaba from very high to very low. We're going to be profitable on Alibaba probably within the next week, and our position is 3 or 4 times the size as when we started. And that's how you take advantage of it. And when the thing's back over 200, we'll be up 100%. So that's what you have to take advantage of. Is when you're buying quality when it's on sale. Even if you don't get the perfect bottom, you can always buy more. You can sell those things that have lower upside potential to buy those things that have higher upside potential if it moves against you further. It's not the end of the world. You just have to take advantage when there is stuff to do. So, and we just laid it out with her, Home Depot down 35% off its highs, Meta down 58% off its highs. Mark Zuckerberg figures it out sooner or later. He screwed up with mobile. He figured it out. He's done fine. Apple threw a roadblock with their privacy. He'll go around it. If he can't grow organically, he'll buy it like he bought Instagram. The guy figures it out. You're betting on the jockey. Stock's down 60%. What are you waiting for? I mean, could it go down another 50%? Yeah, maybe the metaverse bet blows him up for good. Like, he's totally wrong about this. But what if he's right? And the answer is he's got a hedge because he can always stop spending on the metaverse. And he's got these businesses that as business gets going again, yeah, maybe you got a shallow recession. It's the best advertising platform in the world right now. Maybe that changes with TikTok or TikTok takes some share. But they'll figure it out. I mean, the good thing that Mark Zuckerberg does is he just rips everyone off. I mean, candidly, if you're an owner of his business, look at Snapchat. Like, Snapchat had a great thing going. Zuckerberg, he just rips off all the best ideas. Bill Gates was exactly the same way. So he's a modern day Bill Gates, And, you could say, well, they shouldn't do that. Or you can own their stock and benefit. And that's up to you. Leave the ideology aside. Is the guy a moneymaker or is he not? And the answer is, over time, he's a moneymaker. And that's all you need to know is over time. You don't need to make them to make money for you every single year. You just need them to make a lot of money for you over time. And it's the same thing when you pick a money manager, by the way. You need a good manager. That's the best thing you can ever do is to buy a great manager when they've had a bad year, because then they're making it up and you get the benefit of all of that, and you know that their investment process and track record is sound. That's when you make tons and tons of money. Is buying good managers in a bad quarter or a bad year, and then they're off to the races, and you catch that as they just rip up to the high watermark and beyond. So okay, so even though you didn't pick the perfect buyout, okay. Now, so we talked about Meta, Disney down 54%. Come on, okay, could it go down another 25%? Yes. So what? Don't buy on margin. Just tuck it away. 3 years from now, you're going to be, smiling so wide you could eat a banana sideways. Same thing with Starbucks. 42% down. So these are high quality businesses. We're not buying anything sexy right now because the market's still uncertain, but we're buying things that we know have a moat, that are high quality businesses that are going to be home runs if you can just look past tomorrow and to a brighter day, 12, 24, 36 months out. China, we've gone through this loose monetary policy. They're stopping the virus curves. They're opening up the cities. Tech crackdown's over, election in November, Ant Financial IPO, Biden lifting tariffs on potentially $300 billion of goods. Europe, they're back into quantitative easing, even though they're calling it something else. So now you've got two central banks that are easing while the U.S. is tightening. That's global coordinated policy. On Wednesday, Fox Business journalist and producer Ellie Terrett asked me, what'll happen to stocks if the Fed keeps hiking to fight inflation? And here were my thoughts. This is an important commentary that I went over. The market has priced in most of the hikes at this point. The 2-year yield is at 306. It's come down since then. Implies 2 more 75 basis point hikes, which we may not even get. My bet is 75, 50, then stop. My bet is actually lower than that. I think maybe you don't even get 75. They just don't have any data to stand on right now. So the minute they get a light CPI print, they're stopping. Okay, that's just the bottom line. But or dramatically paring down the tightening that they're doing. So the PPI was not enough to do that. But in coming weeks and months, we'll see more of that. So by July 1995, the last time they did a 75 basis point hike was November 1994. By July 1995, they were cutting rates again. The market averaged 28.7% a year compounded the next 4 years. The second inflation starts to slow down, they'll stop hiking. PPI is the leading indicator, and that peaked in April. CPI will follow. PC DRAM also dropping along with shipping rates. Chips are 1/3 of inflation due to new and used car prices. Used car prices up 60%, down recently 6%. Long way to go. Auto chips are beginning to flow again. That'll help. China tariff reduction will help. Rig count back to 740 last week, up from 244 pandemic lows, up 203%. Approaching pre-pandemic level of 792 on the rig count. This is not the 1970s again. Technology lowers costs. Okay, a lot of people are going to be put out of work by technology, and it cuts costs. So when the economy slows, tech spending goes up because big companies look for ways to cut costs. This is a short-term bottleneck that is slowly working its way through. Mortgage rates doubled in 6 months. Demand will slow. Just works on a 4 to 6 month lag. Not an on-off switch. Think of it like stopping a boat. If you're going 60 knots and you cut the power, you don't stop right away like a car. You go maybe another 50 yards until the boat, literally the friction slows it down with the water. So, okay, Cheddar. On Tuesday, I joined Kristen Scholler on Cheddar News. Closing bell to discuss the stock market, economy, and what we're doing to take advantage of the volatility. This is where I walk through that situation. This is definitely, you should check this out. Thanks to Kristen, Allie Thompson, and Talia Torella for having me on. I cover some of the show notes, but we mostly didn't cover these show notes on the show because there was like this live January 6th hearing going, and they had to cut. They were covering that for hours, and then they had to cut back to it. So it was only 6-minute interview. But she has some great questions, and I think you'll find the answers very helpful. And then CGTN America, this is with Phil Yin. Really enjoyed this. We talked about China Tech and Alibaba, so you definitely want to check this one out. Always a lively, exciting interview. Going back to our second largest position, just a hair. It's about the same size as Alibaba. These are both huge positions for us. Last week, we spent a lot of time going over our third largest and newest position, which, by the way, has probably more upside than both of them combined if it works, even though it's a smaller amount of capital. But to take advantage of the dramatic operating leverage embedded as semiconductors start to flow back to their clients, the OEMs, we've also spilled a ton of ink on our largest position, Alibaba, in recent weeks. But we haven't covered our second largest position, biotech, in a few weeks, so I want to give you an update as the thesis is starting to play out. If you're new to our work, you can view our recent podcast, VideoCast, and weekly notes by clicking on the hyperlinks. Besides historic low valuations, whether you look at price to sales, price to book, price to operating cash flow, forward PE, percent trading at a discount to cash, etc., we outlined a few key catalysts that have now started to manifest in recent weeks. One key catalyst we defined was that Big Pharma has record cash on its balance sheets and a number of patent cliffs coming due. They will have to buy innovation to grow, and once one of them makes a move, they will all get fear of loss, and animal spirits will return to the sector. This was our thesis. This has now happened. That catalyst started last month when Pfizer announced the purchase of Biohaven for $11 billion. It's just the beginning. Here's what has happened since and what is on the horizon. So you had the $11 billion deal in May. You had a small $2 billion deal in April when GlaxoSmithKline bought Sierra, then a $1 billion deal with Halozyme and Antares. But once you saw Biohaven kick off, now you saw GlaxoSmithKline buy Affinivex for $2 billion. And then in early June, you saw Bristol Myers buy Turning Point for $4.1 billion, another huge deal. And then Friday, there was rumors that Merck is planning to buy Seagen for $30 billion plus. Talk about animal spirits in the sector. As a reminder, these are the catalysts we're looking for to play out in coming months. Biotech is idiosyncratic, correlated with R&D results plus M&A over rates and general indices. So if you're looking at the NASDAQ for a tell on what biotech's going to do, it's not as high a correlation as you think. So after XBI sold off 52% on hiking fears in early 2015 to early 2016, the sector rallied 131% during the tightening cycle from 2016 to 2018. 2. Possibilities for R&D news catalysts to drive the sector this year. Therapy results for amyloidosis, Alzheimer's, lung cancer, and schizophrenia are all on the horizon. Those are big, big announcements that could be coming out. 3. Short squeeze. Very high short interest across the sector will get crushed as more deals and drug results are announced in coming months. With this deal flow, do you want to be short any biotech stock right now and you wake up the next day? And these have not been... Look at these premiums. Could you imagine being a short in any of these deals? The smallest premium was this GlaxoSmithKline thing that was a 39% premium. That's a big loss in one day. How about if you were short Biohaven, you lost 79% in one day on the announcement. How about if you were short, I think this is a private deal, but Therapeutics MD, 367% premium. Here's one. That's the $4.1 billion deal, 122% premium. You're looking at an average of 100%. You want to be short any of those? These guys are going to have to cover their shorts, and who are the most aggressive sellers are going to be the most desperate buyers of tomorrow. Reverse mergers. We've covered the number of high number of biotech components trading at a discount to cash. These will be fertile ground for M&A and reverse mergers of private companies and drugs to unlock value in these zombie public companies. So what's trading like dead at a discount to cash, you stick a drug, you stick a small private company into it, it's going to be up 3, 4, 5x. And then lastly, the FDA is normalizing. They're shifting back to drug approval. They've been focused exclusively on COVID vaccines and antivirals. Now a multitude of clinical holds are going back into action, and they're now back on track. So that's a big deal. Sentiment still at levels, historic lows where you probabilistically want to be a buyer, not a seller. Bullish percent dropped to 18%, bearish percent up to 60%. You don't need a scalpel, just with a crayon here. When it's low, you want to buy. When it's high, you want to sell. Same thing with the fear and greed, confirms that at 22. And then the National Association of Active Investment Managers, their equity exposure is the lowest it's been since the pandemic lows. That's all you need to know. Once this thing has a catalyst up, we don't know what the catalyst is going to be. These people are going to be desperately chasing, and you're going to be benefiting if you've been listening to what we're saying. Earnings estimate revisions, top 30 weights for technology, revised up, not down, up by 1% in the past 60 days. 2023 is also up by 1% in the last 60 days. You can go through them one-on-one. Carter put these up. Good job. Communication services sector, this thing has been completely decimated. Earnings are down 2.7% in the last 60 days, 3% for next year, but the sector is down like 35-40%. So those divergences we're very interested in. If you go company by company, you got the Metas in here. I mean, they're Netflix, Disney, AT&T, Comcast. Like every single one of these are basically at or near buy levels in terms of valuation historically and opportunity. And then financials, our estimates are down by 0.62% this year, 0.91% next year, but these stocks have fallen like 30-40%. Many of them now trading back at a discount below book, so there's opportunity in the difficulty. Here's earnings. They continue to just climb up, 251.76, etc. The economic calendar, existing home sales were pretty good this week, better than expected. Continuing jobless claims were in line with expectations. Initial jobless claims came in worse than expected, so the Fed's goal of causing a recession is starting to work, or tightening conditions is starting to work. Manufacturing was down, so again, that slowing is showing up in manufacturing and services. Market's a discounting mechanism. Obviously, saw a lot of this coming, which is why we're down 20 and 30% on the S&P and NASDAQ respectively. So with that said, look, wanted to cover a lot of stuff at once. We are going to have the Chandler Brothers CIO. If you recall, they turned $10 million into $5 billion in 2 decades. We're going to be recording that, I think, on July 1st. So that'll be out the first week of July. It will be your weekly podcast. I can't wait to hear that. And you're going to just learn from some of the best. Buying quality things when they're out of favor, when no one wants them. Over time, you can generate really unbelievable wealth. And we're going to hear firsthand from their CIO. So with that said, I want to thank everyone for tuning in this week. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.